The 325 basis point interest rate cuts implemented by the South African Reserve Bank so far have seen a modest improvement in the financial position of South African households. According to the fourth quarter Altron FinTech Household Resilience Index, the ratio of household debt costs to disposable income has declined to 8.9%. The index also reflects that year-end bonuses, temporary jobs over the festive season, and withdrawals from pension funds were contributing factors. Economist Dr Roelof Botha discusses this with us. Thank you, as always, for giving us your time, Dr. Botha. Let's first unpack the factors that contributed to this modest improvement.
Yes, fortunately, there was an increase in private sector employment, which is always good news. And households had a little bit of more money to spend. The ratio of household income to debt costs improved marginally, although it's still lower than before COVID. And I think we all know why. It's because of the record high interest rates. But the standout performers, unfortunately, were withdrawals from long-term savings via the two-pot system, which was introduced in the third quarter of last year. Now, although this provides households obviously with more financial resilience, it's short-term, and it does have a detrimental impact on their long-term savings. So it's not actually recommended. But when you have no choice, because your debt cost burden has risen from 6.8% before the Monetary Policy Committee started raising interest rates. It was 6.8% of disposable income. So if you earned 100 Rand, you were spending 6.80 on servicing your debt. Now that's close to 10 Rand. It's, well, actually close to 9 Rand. So there's been a significant increase to the highest level also in almost 2 decades in the amount of money that the share of their incomes that households have to spend on interest on debt. What it means is that there has not been the slightest indication of demand inflation in our economy since before COVID. So higher interest rates cannot fix a 700% increase in global freight shipping charges. It cannot fix a 400% increase in the oil price, which were the 2 reasons why our inflation rate went up in 2021. And what frightens me is that we have a Monetary Policy Committee at the Reserve Bank that believes that you can combat these cost-push price increases by by taking it out on households and taking your interest rate sky high and raising the cost of capital and the cost of credit. It makes absolutely no sense.
I'd like to interject there, Dr. Botha, and maybe ask about then what a near-term outlook would be, especially as you warn that households are not out of the woods yet. We do know that the Reserve Bank was still as cautious at its last meeting when it decided to hold on rates.
Yes, that's even scarier. The fact that they did not use the opportunity at their March meeting, the MPC meeting, to lower rates further. Myself and several other economists and analysts were hoping that they would use the opportunity in the absence of demand inflation and in the absence of meaningful growth to keep on lowering the interest rate by 25 basis points at every second month at their meetings, but it didn't happen, which is a huge problem. The withdrawals from lump sum payments from official pension funds year on year, according to the Altron FinTech Index, was 36% increase year on year. This is scary stuff. At the Optimum Investment Group, where I'm the economic advisor, we've also picked this up, and we advise people, think twice, think 3 times before you dip into your savings. Quite frankly, the monetary policy of this country is not doing us any favors right now.
Lastly, Dr. Botha, what does this mean for sentiment, especially as Budget 2025 is still in those realms of uncertainty until we get to the 21st of May?
Yes, as you've pointed out, there's so much uncertainty right now. If you look at the S&P Global Purchasing Manager Index, the Stellenbosch Bureau for Economic Research, their PMI for manufacturing, it's been below the 50 neutral mark for quite a while. The good news is that we created 400,000 jobs, more than that even last year. The good news is that the Government of National Unity has shown us especially at Home Affairs and at the Public Works and Infrastructure, that they can make a huge difference if they can just get beyond this VAT fiasco and start spending money as quickly as possible on improving South Africa's roads, railways and harbours. Then we can go places. In 2025, we need to create jobs quickly, and there are plans on the table. And one of them is the World Bank roadmap, which we requested, how to get South Africa to higher growth. That report was provided to government. They requested it 2 years ago. It's on their table. They just need to implement this, and that means radical reforms in the public sector to get rid of people and institutions and divisions and departments that do not add value to the economy.
Thank you as always for your input. Dr. Roelof Botha is an economist talking to us about the latest Household Resilience Index.